Hello, welcome back. In this video, we are going to examine ASML Holding, a company that has recently been the talk of the town because Bridgewater and Ray Dalio have bet against it, and quite significantly as well. Now, in case you are not aware of this one, it's a semiconductor equipment company. They are basically producing these super expensive machines. I believe they are called photolithography systems, with which semiconductors and chips basically are created or generated. And they're very important machines, and obviously they are very tough to design and make and produce pretty much. And so this company is almost like a monopoly. Now, you will see that they don't have too many customers. It's like TSMC, I believe, and then it's like Samsung. However, they could be selling like 30, 40 machines and basically be making tons of money just because they are extremely expensive there. This is basically what their core business is. And if we take a look at the stock news here, you will see that Bridgewater bets 6.7 billion against European stocks. You can take a look at it here, this article. They have bet against 21 European companies so far this week, from sectors ranging from finance to energy. And ASML Holding is actually one of their biggest short bets, as you'll see here, with 1 billion. So there's a very strong conviction actually in terms of this bet, and I'm curious to see whether that's a good bet here and what are they relying this on. Now, you will see that when it comes to magnitude of short selling, we don't recall any other money manager coming close to this except for Bridgewater itself, said Breakout Point. So they are betting pretty much the house in this market collapsing pretty much, and basically a lot of European stocks going down tremendously. Now, do they have any basis, any reasons for this? Well, of course, yes, they do. Generally speaking, as as there is burning inflation, insane problems with supply chains. Basically, what has happened with COVID lockdowns, the whole economy has been completely annihilated for a while. You're seeing interest rates, the value of money going higher. The value of getting a loan, for example, is much more expensive right now. And companies that handle a lot of debt, they require a lot of liquidity, they can have a lot of trouble navigating this. Now, you have to remember that money circulating and basically cheap money circulating in an economy is the basis of the stock market going higher. And so if we get higher prices, higher interest rates, and higher inflation, this kind of money that circulates for liquidity purposes around all sorts of different companies is less and less. And so it becomes much tougher to navigate challenges and basically deploy capital in order to make these machines, these very expensive machines, for example, in this case. And it basically points to Bridgewater thinking that there's going to be a massive slowdown here, at least in terms of all of these European companies, European stocks here. It looks like Bridgewater is mostly betting on the European collapse, really, and not so much in the US collapse. It looks like, at least based on what the article is pointing out here, which I understand. I kind of understand it. It does make some sense based on what has been happening with Europe lately. Things seem to be a little bit more dire. But overall, the global economy is currently undergoing some heavy issues right now. Now, I do want to examine the company in terms of its financials because it has been going down 47%. And it used to be close to $900. Right now is almost half of that. Now, you can understand, and you need to understand that Ray Dalio's bets here includes a lot of ifs. Like a lot of things need to be going wrong and his way, or the Bridgewater's way really, for this sort to actually flourish. Now, that doesn't mean that they won't happen, but it does mean that we don't really know about this unless maybe we have some insider information, which we don't, at least from our side. But you cannot really know for sure whether this is going to be the path that will happen eventually. It does look like we're entering a dire situation for the markets, but this doesn't mean that necessarily this company will go down in flames, for example. On the other hand, this is a company that is actually again creating proprietary equipment that is very, very hard to do. So they can't have too much competition really. They don't have much competition. It's very tough to design these machines. They're super expensive. You need to pay a lot of money up front to design them, and they are extremely useful for what they are doing for semiconductors, which are all the fast these days. They are super important, and we did have a lack of those recently, and so you would believe that this company's stock price could actually propel upwards instead of going downwards really. And so I'm very, very surprised, frankly, about this massive bet on the downside from Bridgewater. And also, I'm even more surprised here when I'm taking a little bit of a look at the financials of the company, which do not appear to be that bad at all. Now the company is buying back shares, for example, and the price to free cash flow ratio is fair, 18.2, not too cheap, but fair. Now the PE may be a little bit expensive here, but take a look at this as well, total liability to free cash flow. The company doesn't seem to be having a lot of debt, which could be a potential issue, especially this liquidity troublesome era right now. And overall, revenues have been increasing, net income has been increasing, free cash flow has been increasing. Of course, it is a cyclical company that needs the economy to do well in order for this to do well at all. But I don't see something particularly terrible here about this one. Debt to equity ratio that is very, very fair here. The returns that the company has are amazing, and the margins are amazing too, again because they can charge a lot for what they are doing. It's very, very tough to produce this kind of machinery. And the dividend yield of 1%, if you take a look at the dividends tab here, you will see that the company does pay some dividends pretty much recently started to, it looks like. They don't seem to be very, very regular here. Recently they have been sort of like quarterly. For the most part, I guess, maybe even semi-annual or so. A little bit of a weird case here, but the current dividend yield is 2.8%. But if we take a look at the stock analysis tool here and we go back, you will see that the payout ratio is about 18% and 34% in terms of its net income. So it's more than easy for the company to actually pay back all its dividends here. Now let's take a little bit of a closer look at the financials of the company in detail in terms of the financial statements. You will see that the revenues have been increasing, doubling pretty much from 2017, and a net income of 2.5 to 6.4 billion over here. So the company doing well over the years, and remember we had years where the whole economy was going higher basically, and so that does help them a lot, of course. So it does look like Dalio and Bridgewater are basically betting on that downturn to happen, and their revenue getting suppressed as well as their net income. I'm pretty sure that's what they are mostly betting on. And 12.8 in equity from 12.8 to 11.5. But remember, the company has been buying back a ton of shares really, and so this makes a lot of sense that their equity is going down here. And the debt is 4.6 billion, their long-term debt. That's an interesting metric here to see what kind of long-term debt they have, 4.6 billion. Because I want to check the cash flow statement. The company makes 11.2 billion. They need about half a year to actually pay back all their debt if they wanted to. That's the long-term debt. So I feel very comfortable in terms of the company's position of paying back debt. And that matters a lot if we're entering a downturn. Now, the net cash provided from operating activities here will be about 12.3 billion, was actually to 12.3 billion. There was a little bit of a change in working capital. That happens when current assets minus current liabilities gets changed, basically it gets adapted. So the company over here is actually adding back some cash. Because if you take a look at the balance sheet here, you will see that there has been a change in the total current assets. Over here they haven't changed a lot, but the total current liabilities have changed a lot, 13.9 billion here. So this means that the overall total current assets minus total non-current assets minus total current liabilities has changed, and this is what you are seeing here, an adaptation in terms of working capital. Because when the company, for example, increases their working capital, they have to pay some money. So for example, when they are getting some inventory, they have to extract some money from their cash from operating activities here. So you're going to be looking at a negative value there, and the opposite when the company has more total current liabilities. So that's how it gets affected here in terms of the cash from operating activities and the cash flow statement. Now the company's cash from investing activities is almost zero here, not much going on really, almost unaffected. Some capital expenditures, of course, they're paying 1.5 billion in dividends and minus 11 billion in terms of their overall financing activities here, because they have been repurchasing common stock, a lot of repurchasing of common stock for this company. Nice to see again for shareholders. Now, the last step we want to see, the company is looking great in terms of what they are doing, and of course I can understand some environmental pressures, or some, I would say, some seasonal pressures, what is happening right now with the markets. You will see that the revenue growth of the company has been pretty stellar here overall. And let's just try to go low. Let's go 8, 10, and 12. And the net income margins have been relatively high. Again, they can charge a lot. So I will go 22, 24, 26. That is 24 here. And the free cash flow margins close to 90. Whoops, I shouldn't change this one. So let's go let's go 85, 90, and 95 here, and 13% for our annual return. Let's see what we're getting out of this one. So yeah, it is expensive, it looks like, based on these kinds of projections. Now, I did go low in terms of my revenue. The company could do more. Let's actually try that, just see what we're getting out of this one. Let's just go with something higher. Let's go with 14, 16, and 18, which could as well happen. I mean, it's only 1 year where the company had 80%. Every other one was at least 18. And if we hit calculate here, you'll see that we're again in the red. So I do understand the fact that the company is overvalued for what it is, but actually sorting into this one may be a little bit of a bet here, a little bit of a strong bet, I should say. It doesn't look like the company deserves like that much of a strong sort over here. Although, of course, you know, Bridgewater, Dalio, there are so many people over there, so many analysts. They definitely know what they are doing. They have some ideas at least and some information potentially. But based on what I'm seeing here in terms of what the company is doing, I'm just not seeing the real value here in sorting this one. I wouldn't buy. I wouldn't buy this one, but it's still a pretty successful company, it looks like. And they are seriously betting on a massive downturn here, is what Bridgewater are doing. I wouldn't buy this one. I think it's expensive, but I wouldn't sort it either. I think it can be having a propel, can actually propel its price, its stock price upwards, especially if we exit the current slump in terms of the supply chains. So yeah, it's a big bet, interesting bet, but I did want to examine the company a little bit as a retail investor, not having all sorts of information about what is happening on with the company. I mean, again, Bridgewater could be having some insider sort of like information, maybe completely legally. But based on what I'm seeing here and what the company has been doing, based on its financials, it's not a company that I would sort. It does look pretty nice. Expensive, but still nice. So I would probably just be neutral on this one. Thanks for watching, guys. Remember to leave a like and subscribe, and let me know what you think about ASML and this Ray Dalio short bet. What is that about, and whether you agree with that or not. Thanks for watching again. I'll see you soon. Bye bye.